In the last 10 years, the market gave investors 3 real reasons to panic. 3 moments where selling felt like the only smart move. Every single time, selling was the worst possible decision. Today I'll show you exactly what happened and what the investors who did nothing ended up with. Crash number 1. Late 2018. In just 3 months, the S&P 500 fell 20%. The Federal Reserve was raising interest rates. Financial headlines were screaming recession. Trading floors were tense. Anyone watching the news in December 2018 had every reason to believe this was the beginning of something much worse. Investors who sold near the bottom locked in their losses permanently. The companies inside the S&P 500 didn't get 20% worse in 3 months. Only the price changed. Investors who did nothing? The market recovered within about a year and went on to new highs. That's crash number 1. And it wasn't the only one. Crash number 2. 2022. This one lasted longer and hurt more. Inflation hit 9%, a 4-decade high. The Federal Reserve raised interest rates at the fastest pace in 40 years to fight it. From peak to trough, the S&P 500 fell about 25%. Both stocks and bonds fell together, something that historically almost never happens at the same time. It was one of the most painful years for a balanced portfolio in decades. Investors who sold in 2022 locked in a 25% loss. Investors who held. By the following year, the market had recovered the majority of those losses and gone on to set new records. Same pattern as 2018. Different headlines. Crash number 3. April 2025. This might be the fastest, sharpest example yet. New tariff policy was announced. Within about a week, the S&P 500 fell nearly 20% from its high, at one point brushing up against official bear market territory. It was one of the largest 2-day drops in the index's history. Panic was everywhere. Then, just as suddenly, the policy shifted. Tariffs were paused, and the market staged one of its biggest single-day rallies ever. Within about a month, the S&P 500 had erased most of its losses. Investors who sold during that week in April locked in a massive loss in a matter of days. By the end of the year, it finished up more than 16%. Investors who did nothing barely noticed it happened by December. Here's the mental shift that separates investors who build wealth from investors who don't. A crash is not a warning sign. It's a sale. When the S&P 500 drops 20%, you're not watching your money disappear. You're watching the same 500 companies go on sale for 20% less. Nothing about their actual business changed. Only the price changed, temporarily. If you're still adding money every month, through a 401k, an automatic investment, anything, a crash means your next contribution buys more shares for the same amount of money. That's not a disaster. That's a discount. The investors who understand this stop asking, "How do I avoid the next crash?" and start asking, "How do I make sure I'm still buying when it happens?" So what actually happened to someone who kept investing through all 3 of these crashes? 2018, 2022, and 2025. Without stopping, without timing anything, without trying to guess the bottom, their monthly contribution bought fewer shares in the good months and more shares in the crash months, automatically. over the full 10-year period, those crash month purchases turned out to be some of the best performing dollars in their entire portfolio. This is the entire argument for staying invested through volatility. You don't need to predict the next crash. You don't even need to enjoy it while it's happening. You just need to keep going. The crash isn't the risk, selling is.